This is your economic review. My name is Simba Elijah Charles Kenya. You're watching a Business AM. According to the Business Daily, the Institute of Certified Public Accountants of Kenya, ICPAK, wants the 1% minimum tax levied on businesses to be deferred for 2 years to enable businesses ruined by the COVID-19 pandemic to recover. Speaking on the sidelines of their 29th annual symposium, ICPAK Board Chair Rose Maura says that many companies were forced to lay off employees due to cash flow strain as well as reduce operations. And I quote, there is a need to defer the introduction of minimum tax from 2021 to 2023 to give businesses and the economy at large an opportunity to recover from the negative effects of the COVID-19 pandemic. And quote, now the tax, Ms. Maura says, that took effect last month might fail to raise the expected revenue and may result in adverse economic distortions that will hurt Kenya's competitiveness. Last month, manufacturers, suppliers, lawyers, insurers, accountants, retail, hotel and operators called for the shelving of the 1% minimum tax pegged on the gross revenues, citing the current economic hardships. Now, capital-intensive projects generally have a longer payback period, and imposing additional taxes on them discourages investments in the country. That is according to Maura. And she called for minimum tax exemption for low-margin businesses. All right, let me introduce the panel that we have for you this morning. We're going to take us through our economic review. We do have Sid Shah, we do have John Mwaniki, and Arnold Nkisale, who's a microfinance banker as well. John Mwaniki is a financial analyst, and Sid Shah, is a lawyer. Good. Let me begin with you, Sid, this morning. I mean, Kare would argue that there are two sides to the coin. That despite ICPAK calling for the sort of shelving of the minimum tax for the next 2 years, there's also that side that you shelve it, then you might find that the same businesses who are actually struggling are paying more if you look at the other side of the coin correctly.
Yeah, thank you, Simba. Thanks once again for having us on the show. Let's understand why the minimum tax was introduced. First, just to give a brief note on what it is. It's a corporate tax of 1% on the gross turnover of a company's business receipts before taking into account any of the operating overheads or other costs of doing business for a company. This means that the businesses must pay corporate taxes above 1% of its turnover, irrespective of its profit position, and therefore even loss-making companies would be required to pay the tax. So let's try and understand why KRA introduced the minimum tax in the Finance Act of 2020. Apart from expansion of the tax base in the country, the minimum, according to the KRA at least, the minimum tax is set to level the operating playing field for business enterprises by ensuring that, almost all sorts of businesses contribute towards the government effort to mobilize resources for growth and development. And then, while loss making is part of the day-to-day journey in an ideal business environment,
yes,
generally not practical for a business entity to consistently post losses in perpetuity and still remain afloat. And I mean, this has been one of KRA's big reasons as to why they've introduced this tax, that there are many companies out there that have been posting losses in their P&Ls for a long period of time. And it's sometimes difficult to wonder as well from a taxman's perspective how such companies actually do remain afloat. So it is expected that, the introduction of this minimum tax will not only seal such loopholes, which costs obviously the government billions of shillings in revenue every year, but it's also to ensure some sort of equity and fairness in the distribution of the tax burden across, the entire tax brackets in our country. But if you look at it from the perspective of the Public Accounts Committee of Kenya, you know, we understand from a business perspective why the tax has negative consequences.
Yes.
You know, if its objective is to ensure that companies in tax losses pay a fair share of corporation tax in spite of their losses, you know, then this is contradictory because in the short term, taxable profits or tax losses arise because of justifiable reasons. It's not every company in Kenya that, you know, tries to take advantage or tries to post losses in perpetuity. I mean, there are justifiable reasons like macroeconomic factors such as, you know, political instability, inflation rate, which we know over the past 1 year has been going up and up, natural disasters such as, you know, COVID-19. You know, these are all justifiable reasons for a company, you know, to either underperform and post losses. If you are imposing a minimum tax on such companies, you know, the cost, the cash flows are going to be negatively affected because they're supposed to be paying taxes on either, you know, an imaginary profit that may or may not be there by the time they actually do their proper accounts. So based off that, I don't know if it does, you know, in my opinion, at least, I would agree with what the ICPAK have to say on this.
Yes.
And another reason for this is it's not clear on how tax losses and capital allowances would be considered as utilized. Because given that the minimum tax is based on turnover, the taxpayer tends to lose the ability to benefit from capital allowances, capital allowance deductions, or tax losses, where they would pay the minimum tax for that particular given year. And to make the situation even worse, the loss carry forward period is fixed at 10 years, meaning that taxpayers who are unable to utilize these tax losses for the years when they are paying minimum tax should stand to lose them after the expiry period, which generally for businesses, it's not a good picture to say the least.
Yes. I'm going to come back to you, Sid, on what the absolute definition and understanding of minimum tax is according to the Finance Act 2020 and exactly what KRA has been preaching. Well, let me introduce Joanne also to this conversation. Joanne, good morning. Happy to have you around. Do you share the same sentiment that Sid has now on that minimum tax being charged for maybe 2 years as businesses recover from the effects of the coronavirus pandemic?
Thank you for having us today. And yes, I agree with Sid on his opinion that this is ill-timed and
Yes.
needs to be shelved for another 2 years. Reason, of course, is being the fact that of the pandemic, that businesses have been struggling very much to stay afloat. And remember that we came from an election year, 2017, 2018, recovery, 2019, on recovery period, and then now 2020, a pandemic. So basically, businesses have not been able to get their footing in the last 3 years or so. So I think that the timing is ill and should be done after 2022 in the 2023 period. And KRA may not achieve much success in terms of collection because how do you net these businesses? How do you put how do you get a business to I mean, how many businesses can you put together and say, okay, I'm collecting the minimum tax? So in terms of compliance issues, there'll be a problem in terms of netting everybody, bring everybody to the bracket. So success in terms of achieving this may not be very successful. And I think I agree with ICPAK that we need to shelve this until after the elections, when we have an economic recovery and businesses can now take an upward trend.
Pretty much. Now, Sid, let me come back to you. And John, I'm going to come back to you on that as well. I mean, gross turnover, Sid, is just pegged, minimum tax, according to KRA, is just pegged on gross turnover. That any business that says, well, we're making losses, that the only tax that you're bound to pay under that is just minimum tax, which they argue sometimes might be lower if you're compelled to pay other taxes when you are loss making within the economy. Then why are we making so much noise about, well, why we might need to shelve it for the time for 2 years as we wait for businesses to recover within the economy?
Simba, if you look at the Finance Act, or even if you look at the Income Tax Act,
Yes.
there's currently no definition for the term gross turnover.
Yes.
And in the absence of a definition, taxpayers may have to rely on various accounting standards when determining the gross turnovers for purposes of computing the minimum tax payable by such taxpayer.
Yes.
However, even reference to accounting standards may still create some confusion depending on the adoption by different taxpayers, sectors, and the various different business operations. Some of these sectors that may be significantly impacted will be, telecom companies, clearing and forwarding agents, joint ventures companies, etc. And where there's a lack of clarity as to the revenue base for the purpose of applying minimum tax, it must be worthwhile for a taxpayer to seek a ruling from the KRA on actually what they mean by gross turnover. So this not only increases compliance issues, but with the whole confusion created around what the definition of gross turnover is, people wouldn't know. You wouldn't get an exact picture on how to what the computation of the minimum tax would be, or either what your gross turnover would be. And coming to the question on if it's paid, my understanding is that the intention of the law is minimum tax is only payable if it's Hello? Sorry.
Yes, Sid, I can actually get you. Can you continue, sir?
Sorry, I'm saying, it's supposed to be payable when the minimum tax is less than the installment tax is less than the minimum tax payable.
Yes.
So what that means is minimum tax will only kick in if your computation of minimum tax is higher than the installment tax payable by the taxpayer. So in essence, it's only trying to increase the tax base by ensuring, we have, if you're bound to pay more tax, then installment tax would not apply and minimum tax would be the final tax payable. However, if your minimum tax would be lower than your installment tax, then installment tax would be the final tax payable by the taxpayer.
Yes. Let me bring in Arnold also to weigh in on this issue. Arnold, good morning, sir. Happy to have you around in this discussion this morning. Do you share the same sentiment as Joanne and Sid this morning? And why would you maybe share the sentiment if you are to?
Thank you so much, Simba, for having us in this discussion once more. When I look at taxation issues in Kenya, I always mirror the same to contribution of collection of tax to the national budget.
Yes.
And I think that's the biggest challenge you have as a country. We're always in a situation whereby the taxman is looking to close in on gaps to fulfill the obligations to the national budget. And for me, I feel I actually agree with Joanne and Sid on this one, and even ICPAK. Taxation is essentially an art as far as economics is concerned.
Yes.
You need to tax in such a way that you stimulate business. And at the moment, we are still looking at the effects of COVID-19 in relation to business performance and in relation to economic performance. So at the moment, it would be prudent to shelve or to defer the minimum tax for now. And I would agree with Joanne until the economy recovers. Unfortunately, between 2017 and now, we haven't seen a full economic recovery. If you look at the budget, it has been on a bear run for the longest time. And if you also look at the strategy of minimum tax, is essentially a one-suit-fits-all kind of strategy, which unfortunately loops in businesses which are genuinely posting losses. So at the moment, I would actually agree with ICPAK and our panelists today that we may need to defer just to stimulate micro economics and also to stimulate small and medium-sized businesses.
Yes, Arnold, let me just catch you, and I don't mean to, because I'm going to actually read directly from the brochure for minimum tax. This is according to the Kenya Revenue Authority. They asked the question, and that's what the conversation is really. They asked the question that is installment tax still applicable and payable? Now, this is how they respond. Yes, where the installment tax payable by a person is higher than the minimum tax, then the person shall pay installment tax. However, where the minimum tax is higher than the installment tax, then the minimum tax shall be payable. That is them saying, I mean, wow. We're looking for what is lesser for you. Don't they have an out here? And given by how the economy has been performing and the fact that it's actually easy for a business to declare losses, then is it not just meeting businesses within the economy on a 50-50 basis?
Yeah, seems fair on face value.
Yes.
Seems fair on face value, but at the same time, I think COVID-19 is something which we could not have foreseen.
Yes.
Under any circumstances.
Yes.
So at the moment, it's only prudent to come up with concessions as far as tax is concerned, just to try and stimulate businesses. It's understandable on the installment tax payable versus the minimum tax payable. It's actually understandable on face value. But on the ground, I feel that we may need concessions, and that's why I agree with ICPAK on this one.
All right, Joan, let's talk about it then. I mean, well, they have to collect tax, and if you look at the exchequer revenue, it has been increasing, but exactly what we're talking about here is they've never actually been able to meet their targets. And if you look at the period between July and December, again, we are talking about them missing that target by around 106 billion as well. Now, I mean, we gotta give it to them that despite, yes, businesses within the economy turning in losses, that at least they gotta get something out of these businesses.
Wow. Simba, I don't know how KRA plans to meet its target.
Yes.
Because remember, there were massive job losses. So PAYE tax, of course, now with people not being employed, is not that feasible.
Yes.
Minimum tax, like they're saying, is between businesses between 1 million and 50 million. I don't know how many businesses made 50 million. Small companies made between 0 and 50 million last year, and are also making it in January and February. So I am not sure how KRA plans to meet its target in terms of revenue collection.
Yes.
I think it needs to look at a more friendlier approach, because you could netting businesses, ask them for tax, and they're not even able to pay that particular tax. So there'll be massive default, massive penalties, massive compliance expenses to recover these taxes. So plus or minus, KRA needs to look at cost versus benefit analysis and see that it's really prudent to enforce that kind of tax, being that businesses are not operating or not operating for at least half of last year.
Yes.
Yes.
Pretty much. I would like us to move into the next issue that we got for you this morning. Well, ICPAK has now got the nod to float a 1.4 billion shillings infrastructure bond, which will be one of its kind for the county governments looking for funds for the capital markets. Now, the Treasury Cabinet Secretary, while throwing his support behind the county, indicated that counties were allowed to borrow for capital projects as long as they were within the set parameters set by the Public Finance Management Act. Some of the fiscal responsibilities of which have been a challenge for some of the counties to meet include fiscal responsibilities ranging from not spending more than 35% of the total county revenues on wages and benefits, county public debt not exceeding 20% of the total county revenue, and spending at least 30% of the county government's actual expenditure on development. Like Laikipia County, that will be a measure of the performance of the county bonds has been releasing quarterly and annual financial results, setting a record in 2018 by becoming the first county to produce a statistical data abstract providing key information on all sectors of the economy, crucial information for investors. Just before we cross over, let's have an outlook of what has been the county's performance in terms of revenue generation as well. So let's cross over to that data that we have for you this morning. Now, let's start from what has been budget allocation for county governments, and it has been increasing, yes. And the latest news that we have around this area is that now they have 409 billion, which is a jump of almost 53 from what we have there, over 381 billion. All right, crossing over to exactly the top three and bottom three in terms of how they have been contributing to the GDP of this country. Nairobi expected to be among the biggest one. Nakuru as well, Kiambu, those come top three. Isiolo, Samburu, and Lamu make the bottom three in terms of the biggest contributors to our GDP. Now, let's talk about revenue collection now for in 2018 to 2020. Now, the only way to interpret that data is that since 2017 to 2020, only 3 counties have been able to surpass that target set by the County Revenue Commissioner. Only 3. Now, Arnold, let's talk about it then. Now, counties can borrow, they can float a bond. What are we talking about here?
But I think that was a brilliant move by ICPAK.
Is it Arnold?
I think so. I actually think so. Reason being,
yes.
I think for the longest time we've been hearing counties crying of allocations from the national government. And if you look critically at the national budget year on year versus the cost of running the country, so to speak, we have always been on a deficit. And that's why KRA is always trying to push up to increase the tax bracket, to increase basically their tax collection.
Yes.
And if someone can come up with an alternative way of raising money for the county, I think it's a brilliant issue. If you look at the county structure versus the central government,
yes,
what was essentially supposed to happen after the promulgation of the new constitution was that initially the counties were supposed to get sort of a stimulus package from the government. And then they were supposed to be able to self-finance themselves through various activities within the counties, which means the collections and so on and so forth. But that hasn't really worked on well since the county government structure came in. So if you have an alternative way of raising money, I feel that it's a brilliant way to do it. I just feel that if it's done according to the correct parameters, as mentioned, you spend only 35% of the monies you have on recurrent expenditures, which are essentially salaries and such for your county.
Yes.
And you can use that for your infrastructural activities.
And
as you mentioned,
I'm sorry, Arnold, let me just come in. I like the way you're celebrating on it, but let's argue it from this end, and I'm going to bring Joanne in shortly so that she can also give us sentiments around this area. Arnold, now, there was a report that was tabled by the Control of Budget just a few days prior to this news now, that majority of the counties were splashing more than 35% of the money that they get from the national government to salary repayments. And only about 10% of that money is what was going into development of projects. And Arnold, argue from this side as well. I mean, even as we celebrate, the owner source revenue, I mean, only 3 counties, Arnold, out of the 47 counties have been able to meet their target. And here's a county borrowing money for development. I mean, what says that this money won't go into recurrent expenditure? And what if these counties don't get something out of this project? Is that no more debt profile to the country?
I think we need to look at it from a different perspective.
Yes.
See, a bond is a promissory note, and it has an inherent interest attached to it. So you have obligations on the bond. So with that in place, it simply means that it will spur you to actually put good use of the money you get from the bond to the infrastructural projects, rather than the normal handouts which you normally get from the central government.
Yes.
What accountability do you have on those funds? You have close to none. So you'll just come the next financial year and say, I need more money. But with a bond, you have obligations if it is properly regulated with the Capital Markets Authority, and the people interested in the bond actually have placements on the bond. If you have takers on those bonds,
yes,
it will simply mean these obligations will spur the counties to properly use the funds. That's my perspective.
Yes,
and that's why I feel it's a brilliant move.
Yes, Arnold, I'm going to come back to you, and your question is going to be, compare these bonds with what other counties are doing. We're talking about regional economic blocks. Would that be a better way out than floating a bond? Joanne, let me bring you in on this as well. I mean, Arnold is saying it's a brilliant move. But if you look at the statistical data that we have from the counties with the control of budget, it speaks otherwise. Some counties have been blatantly going beyond what the Public Finance Management Act actually states in terms of spending all that money. And when we come to the own source revenue, Joanne, I mean, 3 out of the 47 counties are the ones that have consistently hit that mark.
Well, I agree with Arnold that it's a good move to reward people who are working.
Yes.
To reward governors who are complying, people who have a vision beyond the norm of other counties. So if it's 5% who are in compliance, which is about the 3 counties,
yes,
I don't think you should penalize the 3 counties because of 95% who are not complying. So for me, I think if you are complying and you have infrastructure that you can that you want to develop and you have the capacity, I don't think you should be penalized because 95% are not doing what they're supposed to do. So
yes,
for me, it's a good move for the hardworking governors who are who can meet the threshold, and of course there are not many. But I think they should be allowed to do to go beyond because they're performing. So for me, it's a good move. It's a good move.
Yes, I would like us to take a short break, but Arnold, I want to come back to you. Yes, you're celebrating it, but I'm going to ask you, are we blatantly closing our eyes to the way in which our counties have performed since we started devolution? And is it really possible for us to say that it's okay a county can get into a project and then realize something out of these projects, if indeed the only thing we've seen counties cry off since we started devolution is increasing of the money that comes from the national government to the county levels? Then why haven't we seen some of these counties change tact? Because since we started devolution, the biggest contributors to the GDP have been Nairobi, Nakuru, Kiambu, and they'll continue to be, Arnold. Are we saying we can change that by simply giving more money to the counties? But people are arguing otherwise once we come back here on Business I Am.